Hi friends, we are taking up a problem for discussion. It involves the application of international financial management and capital budgeting, or you may call it out as international financial management and capital budgeting, or IFM in capital budgeting. You can just call by any name. So we would like to take to a good level for CA final. Okay, I would like to explain it through a practical scenario. So that being a problem which is having a very high prospects of being asked in the main examination. So now let's just go through that. You have been engaged to evaluate an investment project overseas in a country called East Africa, which is politically stable country. The project involves an initial cost of East African dollar 2.5 crores, and it's expected to earn post-tax cash flows as follows. Cash flows in East African dollars in lakhs 75, 95, 125 and 135. Further, the following information is available. A. The expected inflation in East Africa is 3%. Real interest rate of India as well as East Africa is the same and is expected to remain the same during the currency of the project. Current spot rate is 1 rupee equal to 2 East African dollar. Risk-free rate in East Africa is 7 and in India it is 9%. Required rate of return for the project is 16%. You may make suitable generally accepted assumption in order to evaluate the project. It's a very nice problem. Mark it out as very important for your examination thing. So all of you please just remember one important thing, that before we could take up the matter related to assumptions. So there are two approaches that we have. Approaches are two: home currency approach, then foreign currency approach. Home currency approach, in which what we do is we will bring the foreign currency cash flows into Indian, that being local currency, and we will convert that foreign currency cash flows to local currency with the help of a homemade forward rate. What do you mean by homemade forward rate? Generally, a forward rate will be guaranteed, or it will be provided by the authorized dealer, that being the banker. See, in the case of no support from the banker, we can as well consider the risk-free rate of either countries and forecast the forward rate, and that is backed by interest rate parity theorem. That means based on the interest rate, risk-free rate of either countries, we can forecast the forward rate, and based on the forward rates you can convert foreign currency cash flows into local currency, and converted local currency will be discounted using the local cost of capital, and we can arrive at the net present value. This is home currency approach. So in home currency approach itself, we do have yet another way of arrival at forward rate. So that being, the forward rate can be arrived at not only with the risk-free interest rate, but we can also do it with the help of inflation prevailing in the either countries. Whether you take up interest rate as a base or inflation as a base, forward rate can be computed, and with the help of that homemade forward rate, we can convert foreign currency cash flows to local currency, and then the problem has got to be solved just like any other capital budgeting problem. This is in home currency itself, there are two ways of doing things we have. Another one is the foreign currency approach. What is that? So if the interest rates, I mean the risk-free rate of either countries were known, and when we have the local cost of capital as some X percentage, so if the same project were to be handled in the foreign country, definitely if that particular project were to be handled by a local person, the bankers will feel safe to finance a local person there rather than a foreign person. So if a project in India were to be taken up in East Africa, East African bankers will provide loan to a local person at a softer rate, at a soft rate than to an Indian who is carrying out in East Africa. Just imagine that the project is handled by a local person in East Africa. What cost of capital that project would be accorded with, that is what we call it as a contemporary cost of capital. With the help of contemporary cost of capital, we can discount the foreign currency cash flow and arrive at the net present value. Then the net present value can be converted into local currency with the help of spot rate. Why spot rate and not forward rate? Having arrived at the net present value means today's value, there is no need to use forward rate, and it is sufficient that we can use spot rate itself. So in the home currency approach, we will be using forward rate, and in foreign currency approach, we will be using spot rate. You can even call home currency approach problems as forward rate problem, and foreign currency approach, you can put it out as spot rate problems. Okay. So now let us just look into the assumptions. Say assumptions where we will consider interest rate as a sole factor. This is what I was just referring to as interest rate parity theorem, and contemporary cost of capital at East Africa can be ascertained only with the help of risk-free cost of capital. That of course, when that particular portion is coming up, we will definitely be discussing it in greater detail. So number one, interest rate is one particular factor that we have got to take up. The other one is inflation. Inflation can also be reckoned as a factor for influencing the forward rate. So don't ever get the impression that interest is a sole factor influencing. Even inflation can also influence. So you have that in your mind. Please give scope for many factors, but take one factor at a time, right? So foreign cost of capital can be computed with the help of inflation rate. So in fact, it can even be done with interest rate, and in this particular case, inflation can be used as the base for finding out contemporary cost of capital. Okay. Now, this is what I was just referring about home currency approach. So forward rate, either you use interest rate parity theorem, or you can use inflation as the basis. So find out FR and then go for conversion, and then with the help of local cost of capital arrive at the net present value. And in the other case, foreign currency approach, so find out the contemporary cost of capital either with the help of risk-free rate or inflation, then find out net present value in foreign currency only, then use the spot rate to arrive at net present value under home currency. In fact, the value that you arrive at as NPV under either of the approaches will be almost the same. In case there is any difference, the difference is going to be very, very marginal. That is on account of computational approximation that we have carried out. Now we shall proceed to the next stage. See, what is that next thing that we are expected to carry out? In the next case, we will take up approach number one. Approach number one, where interest is the sole factor influencing the forward rate. So what is that? We shall take up interest as a sole factor influencing. Interest rate parity is what we are expected to take up. Correct. Interest is a sole factor influencing, and based on that, forward rate will be worked out. So home currency approach, under that, interest rate parity is what we are going to take it up, right? So forward rate under interest rate parity theorem. So how that rate is arrived at is going to be based on the interest rates of those two countries. So you would all be knowing that how a forward rate will be arrived at with the help of interest rates. So these are all future value formula. Future value is equal to present value into 1 plus r to the power n, and on either side you will have the interest rate, and because of that you are expected to bring about the forward rate. I hope that you people can easily understand that. So now I will just do one such thing. So you have 1 rupee equal to East African dollar 2, right? So when you find the interest rate for East Africa is 7%. So 1 year later it is going to be 1.07. The one that is to be multiplied on the left hand side is going to be 9%, but when it is taken to the other side it will be taken up as division, and this is for year number 1. For year number 2 to the power 2, for year number 3 it is going to be to the power 3, and so on. That is what you find it is working out to. And cash flow in East African dollar, which is given in the problem as 75, 95 and 135. So in fact it is not that we have got to multiply 1.9633 with 75, because it is an indirect quotation where quote is available for 1 rupee, that is 1 INR for so much of East African dollar. So generally for direct quote we just multiply, in this case we got to divide. So 75 divided by 1.9633 should give you 38.20, and on the same lines we are expected to arrive at this. The PV factor taken at a 16% cost of capital is going to be 0.8621, 0.7432, and this is a very simple work where you have to sum up and then we have to deduct the cost. The cost is going to be 250 divided by 2. 250 is the cost of the project, divided by 2 is the exchange rate as of now, and by doing that you will end up with an NPV, and that NPV what you arrive at in this particular case will match with the other approaches also, but there will always be a marginal difference that you would be getting. Equivalent discount rate in East African country. What is it you do have? Applying the interest rate parity theorem in India where it is 9%, and for East Africa when it is 7%. So it is 16% in India when it is 9. So don't take up 9 and 16 for comparison. So whenever you are applying for cost of capital, it is 1 plus 0.09 representing 9%. So on a pro rata basis, you will just get that, and that particular number is 13.87%. So under foreign currency approach, you can do it at the rate of 13.87, and the cash flows in foreign currency itself you can discount it at 13.87 foreign currency approach. By doing that, you end up with a NPV in foreign currency and 54.045 divided by 2, where you just get 27, and let me just take it up. 54.045 divided by 2 should give you 27.0225. Okay, so interest rate parity we have taken up. Now approach number 2, where inflation can be taken up as the base. Inflation is the factor influencing the forward. So how interest rate we have taken up in the earlier computation for the purpose of finding out forward rate. So we will take up inflation as the basis. If inflation is 3% and the risk-free rate is 7%, it goes without saying that real interest in this case being 4%. So it is for the sake of making our computation very easy, we have just done that as 7 minus 3, which is equal to 4. Strictly speaking, it is going to be 1.07 equal to 1.03 into 1 plus something. That something is going to be closer to 4%. Now with the help of calculator I am just going to do it for you. 1.07 divided by 1.03, that should give you 1.0388. So on that basis 3.88% you can make it out as 4%. So there will not be much of a difference that you have. Now let us just see. real plus inflation is equal to risk free. You do not have that feel that risk free means it is devoid of inflation. It's not like that. So the risk free rate, what a government rate you have as treasury bill rate, that takes into consideration the element of inflation. So inflation is also insulated in risk free rate. So just for the sake of simplicity, we have just added and we have not multiplied. Real plus inflation equal to risk free. So question mark plus 3 is equal to 7. So real rate is same for both the countries. So real rate in both the cases being 4. Now let us just take up, by taking up 4 as real, inflation for the other country is going to be 5. So keeping 3% and 5% as the base, one can arrive at the forward rate as how we have done it for interest rate parity theorem. So we can just do that exercise. So as far as year 0 is concerned, so the exchange rate is going to be 1 rupee equal to 2 European dollars. So if you apply that based on the inflation rate, it is going to be, that is 5% and 3%. You will end up with 1.9619, 1.9245 and so on. So this exchange rate upon using in our cash flows expressed in foreign currency, by using the forward rate, there is that derived through inflation rate, we are ending up with 1.9619, 1.9245 and 1.8879 and 1.8519. So the cash flows are simply divided by the exchange rates to arrive at the cash flow in rupee value, and of course 16% is what you have as a local cost of capital. By multiplying the cash flows expressed in local currency with the PV factor computed at 16%, you end up with a nice NPV. Now we are going to take up foreign currency approach with the help of inflation rate, and by doing that 5% and 3%, the percentage comes to 13.79%. By using the other rate, interest rate, that was 13.76, in this case 13.79. There is only a small difference that you have. So 13.79% usage, when you take it up, you end up with a NPV of 55 East African dollars. So that upon converting into local currency with the help of spot rate, you end up with 27 and dot. So 55 divided by 2, that should be 27.5. Now let us just bring out a summary. The summary will tell the entire story. Home currency approach using interest rate parity and inflation 27.04, foreign currency approach 27.02. And in this particular case, inflation 27.31 and it is 27.50. So as I told you initially, it is going to give you the same result, and the difference is only on account of approximation made. And if the problem is silent, it is better that you try under home currency approach. But a better advice, a smarter advice is to try both the approaches, so that we feel like that we have prepared a balance sheet and agreeing them on either side. Okay, so it is a very nice problem. Market order is very, very important for your examination purposes. So please do watch with greater care, and please do forward to your friends who are preparing for the examination of the ensuing CA final advanced financial management. So with that, I would just conclude as far as this problem is concerned, which is taking into consideration both international financial management as well as capital budgeting. All the very best, and we will be meeting you on some other topic on AFM. Okay, thank you, and please do forward to your friends, and please watch our channel Sreeram Coaching Point, and we do take classes for CA Foundation, CA Intermediate and CA Final, as well as for CMA, USA and CPA. Okay, so convey the message to all your friends. Thank you. Bye-bye.